Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of June 8th, 2025. And in this week's episode, we are going back to the test lab. We're going to check on Viper XL and some of the experiments that he's been going around earnings and see how they're panning out. He's got quite a few more trades under his belt, and he's learned a few lessons, and we are going to touch on those from AI, OKTA, and Path. But before we hop to that, I want to give a shout out to our Discord, a link in the description down below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888 as well as /ViperXL007, where we both post each and every one of our trades, the good, the bad, and the ugly. Last is available in an audio-only format wherever you get your podcast, so look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. Viper earnings. It's really the end of the earnings season. There's really not a big set of players left. I knew that when I started kind of screening for this particular week, and the plays that I was seeing, like one of the ones was Ollie's bargain place, and I'm like, oh man, we must be scraping the bottom of the barrel there. And I played that one, and the liquidity, I was borderline not okay with the liquidity, but I went in it anyway. There wasn't a ton of trades. It wasn't the worst liquidity I'd seen, but it actually led to a little bit of a fill issue. And a lot of times I'll pick the mid price, and the mid price will be really close, and you'll just get a fill right away. In Ollie, the spread between the bid and the ask was somewhere around like 40 cents, 50 cents, which is pretty wide. And so whenever it's that wide, I actually will start closer to the more beneficial price to me rather than just to jump into the arbitrary mid price. Because you'll find different like market makers will kind of swing in, or somebody will drop in, and fill you at that better price a lot of times. And I'll wait a few seconds, and then I'll start walking the order down every few seconds. That's what I do when the liquidity is kind of poor. But it really just speaks to the fact that there weren't really a lot of heavy hitters in earnings this week. There's really even less next week. It's really the end of earnings season. But like I mentioned before, fear not. Earnings season basically ends up being every 2 months it starts, because the earnings season actually lasts for 6 to 8 weeks almost once it begins. So I know you have been doing a lot of screening yourself in some of the different strategies that you've been deploying. And so I thought we might check in with you and see how are your trades panning out that you've been messing around with.
Yeah. To your point about the earnings season winding down, there is a big one next week. I mean, at least a big name. I forget what it is now. But to your point, when I was,
it's so big.
So big. I mean, Chewy's one of them. I guess that's kind of big. But to your point, when I was scanning this week, it's bad when there's companies coming up on the scanner, and I'm like, oh, I forgot that was a company. That was. But there are still a couple decent ones. But yeah, like you said, being really on the lookout for that liquidity trap is definitely important. But I found a few, so I have a few on this week. And most importantly, like I kind of touched on last week, I'm getting more familiar with this strategy. The experimental phase is doing exactly what the experimental phase was intended and designed to do, which is get me familiar with the mechanics, with money in play, but not enough to lose my shirt kind of thing. And we'll actually go over a really good reason why that's important, because there was a corner case that I hit recently that I was like, oh no, this is there was potentially a lot more risk potential than I initially thought. Because, obviously, as I've talked about this strategy, one of the things that I've kind of lauded is the fact that like risk is defined up front. 100% the risk is defined. We know what we're walking into. So the corner case is very interesting to call out as well. But like you said, plays are happening and things are moving and learnings are doing. So let's take a look over here at one of the scenarios. So basically, I'm realizing that there's kind of two primary outcomes that I'm kind of honing this thing into. There's multiple outcomes you can have, but for me personally, there's two that I'm really looking for, and that's important because it creates this expectation of what you expect out of the play, and just helps refine it. So. I'm not going to go deep into what a calendar spread is. We did that previously. You could go find your favorite LLM, your favorite GPT or Claude or whatever. The keywords, the buzzwords, buzzword alert. I guess maybe we could start doing that. Buzzword alert would be calendar spread, horizontal spread. Go throw that in there and say, explain this to me. But very, very high level. It is a horizontal spread because I am selling a recent expiration and I'm buying a long expiration, a distant expiration, usually 2 months out to expiration. Doing that at the same exact time, and that's called a calendar spread. So what this looks like then is, and we talked about this before, that the whole purpose of that is to keep the intrinsic value in check, because both of those options are going to keep each other in check on their intrinsic value. The one thing that differs between them is the extrinsic value and the elevation of volatility going into earnings. So this was a pretty steep example here where, one lesson that I learned previously was taking the at the money strike is the best for this scenario, either just above or just below at the money. So when I opened this, the 125 strike was a call, even though just before close, when we breached into the money, but when the price was down here, I'll make that just a little bit bigger. When the price dipped down here is when I bought this spread at for the 125 strike. So we were right there at the money, captured the initial premium on the short month while buying the premium on the long month. And what happened post earnings was this, I don't know, cataclysmic. Let's see how big this is. This dump fest here after hours, bam, 11%. And we were down 13% at open. But to cross check, the expected move was 11.5%. based on the options pricing. So, that's the other thing I'm learning here is there is so much accuracy in the market. They nailed it. The initial gut move was 11%. So, this went down. So what does that mean for my trade? Well, for one, the option that I sold, so my short month, it just basically instantly was worthless because not only was there vol crush on it, but now we are 11% out of the money on that 125 strike. So hooray, that is best case scenario, because that was, I don't remember exactly off the top of my head, but it was somewhere around $300 or $400 for the premium on that particular leg of the option play. However, like I just said, there is a counterbalance to that. There is the long month, which was expiring. If we zoom out, I think I charted it here. I'm going to make a liar out of myself. I did not. It is in July. So the counterbalance to that is that the option that I bought also loses value. It loses that intrinsic value because it is a 125 strike, and we are now 11% down from that strike. So that's the counterbalance at play. And so essentially what happened here is that front month expired worthless, which is great. And now I'm just holding a long option, waiting for the price to get back up to 125 or even 115, 110, something in there. And that's going to bring premium back into that option as long as it happens within enough time to expiration. So if you're starting to connect the dots, the benefit of that long month being 2 months out is I have plenty of time both for price action to work back towards my strike, as well as extrinsic value to be built back in, because as we get to within that 1 month to expiration window, as we always talk about, the theta decay kicks in and that extrinsic value really starts to decline. So it's a juggling game, a balancing game that I don't entirely have to fully worry about at this point, because what's done is done. And this thing is just, we're riding along, and it will be either worthless or it will become worth something. And we'll see how that plays out.
Yeah, Viper, I like this trade actually, and I kind of like the position you're in a little bit. One, you got 100% of your premium on that short leg. Now, I too entered this same trade, and I did it without a protection leg, and I did both the put and the call of OKTA. So I played both sides of that 11% expected move. And one of the reasons that I was okay with that expected move range, and the thinking of it is, and I'll have you go to a higher time frame chart here, on the put side, depending on how far it breached down, I felt like it was due for a potential retracement on its price action higher, provided that breach didn't be too nasty to the downside. And then the flip side of the call that I had sold seemed close to an area that ended up might be resistance at some point. And so what I think I like about your trade is you got all your premium on that short month, but I feel OKTA still is in a potential upward trend over time. So I feel you're sitting not as terrible as one might think for your long option.
Yeah, absolutely. And that's a good point, because while the core thesis of a calendar spread is you don't care which direction it goes, you're playing a mean reversion pull after a dramatic earnings move. I mean, if you can, so my thinking is, if it technically doesn't matter, then why not let it matter? if that makes sense. Because if it technically doesn't matter, but then there's the opportunity to layer on a little bit more odds in my favor, let's do that. So exactly what you were just saying, if we zoom out here, this did go through my head, is we have this big trend here. I mean, this goes all the way back to 2021. The green dotted lines, don't worry about that. Those are just earnings markers. But what's important is the trend here. You can see that we dropped off a cliff. We bottomed back in November of 22. And then we've just been in this climbing pattern, stair step pattern up since then. Nothing's guaranteed to go up forever. And like you just said, we were coming up on a resistance area, which maybe around 135 is where that kicks in. So as I'm looking at this 125 strike, and I'm like, I can take at the money above or below. Technically doesn't matter. Let's go ahead and take below, so that one of two things happens. If we take the below and this exactly plays out, where my short month expires worthless, and now I have a long position that's just waiting. And you can see I was correct. I did put the long expiration chart line on here, that this option does not expire until July 16th. So I have, as you can see on the chart here, I have this big old gap of time here that I just need it to move 11% back up. And so again, nothing's guaranteed. We could go down to zero. The bottom is zero. But probabilities are that it will, within the next month and a half, there is a strong probability we're going to get that 11% move. And now I am naked exposed, with exposed in a good way. I have no risk left on the table. I am just fully exposed to upwards price action. So if this thing, between now and July, something happens and this thing shoots up to $200, I have a massive, massive win sitting in my account. Not saying I'm expecting that at all. That is not a motivation to take the trade, but it is kind of how the trade is progressing out of when things look like a big loser at first, because this did move so violently, we'll say, against me, even though, it is what it is. There's the nuances there. The value of a lot of options plays, it's not just this option play. The value of options plays are the time. If you build a strategy around that time, then to quote Sprocket's favorite saying, you got options. So that is an example of one such outcome. And this is becoming one of the common scenarios. I want to take a look at another scenario, which I think is really cool because this one gets into the math and the statistics and the Greeks of the trade. So if we hop over to AI, and we take a look at what happened here. So here we have going into earnings, which earnings will be pretty easy to spot on all these charts. It's usually where the giant candle happened because the other thing I'm learning is when you're chasing premium and you're chasing volatility, you get volatility. That's just the way the game works. So I opened this one when the price was up here at this little top here around $24. I bought the $25 calendar spread, which was actually a great time to buy it. Coincidentally, we stair stepped down until earnings and then pop, we came flying up. And so what happened though was we flew up and I was like, I think I even messaged in the Discord. I was like, oh, look at how beautiful this is. We flew up and then we're coming right back. Because I should pause there. One scenario that has not really played out. I'm going to call it the ideal scenario, even though that is highly subjective. The ideal scenario is I get into a trade, earnings happens, and then the next trading day, the price is just sitting peg on my strike. I call that the ideal scenario because that's the fastest turnaround. If the price is sitting dead on my strike after earnings, I'm closing the whole thing out and we're moving on with a nice bag of profit. Obviously, some people, as Sprocket has mentioned before, would be more in it for the OKTA scenario here, where you want the discount on that long option play, but that comes with the cost of waiting for it. So for me, my ideal scenario is what looked like could have been setting up here of we popped and then we were settling right back to my strike, but nobody could wait. And when the market opened, this thing just roared up to $30. And so we were super deep in the money at this point because I, again, was on the $25 call. And if we look, I mean, at peak, that was a 20% move into the money, which is crazy. That is a huge move. And so what I think was crazier, though fully explainable, is what happened. I was staring down a Friday, May 30th expiration. So I'll spare any conjecture on the lesson learned there. But what that means is my short month is expiring on this day, on Friday. And so we're in the money. So what's going to happen is what I talked about on previous video where somebody will get assigned, somebody holds that contract and they're going to want to call those shares at the $25 strike. And that, is going to take a hit on my account. And in theory, I would, like we talked about on a previous video, I would pass that buck to my neighbor and I would cash in and I would early assign my long month option to cover the true assignment of the short month. So I didn't really want to mess with that for reasons we'll talk about in a minute. So this was assignment day. And I was like, you know what? We got a great bleed off the day before. And then we opened down and I was like, I'm out. Let's close this thing up. In my head, I knew I could wait until the afternoon. But I didn't want to gamble it because as you can see here, this was at 30% profit on this opening move down. And because I'm still new into this strategy and emotions and all that stuff are still a thing, I'm glad I did, despite how this would have captured more profit, because this spike here absolutely would have been a panic event where I would have been like, man, I could have had 30% and now I'm like break even, maybe even had a little bit of a loss. So I'm glad I just took the money when the money was there and we just got out and moved on. So I wanted to call out that this is the other common scenario outcome where we move deep into the money And then what is really cool about what's captured here is, if you notice, we're still deep in the money. We're still a whopping almost 10% in the money here, and I'm still at 30% profit. And so that is a really, really, really cool thing that we always talk about, which is the vol crush, which is the elevated IV, the elevated volatility going into earnings. And it's proof positive that one of the things in my strategy I'm focusing very highly on is this IV-RV ratio, which is implied volatility, realized volatility ratio. In Sprocket's strategy, he just uses IV because that's a common thing. I use this IV-RV ratio, which accounts for after hours moves, but it's essentially proving the same thing to our strategies. And so, because in my trade book here, I take a log from my dashboard that I'm building of every trade. When I take this snapshot. So this is the snapshot of my dashboard screener when it said, "Hey, this is probably a good trade to take." And so, what I wanted to call out here is the IV-RV ratio for this trade was 1.47. And all you need to know about that is 1.25 is the criteria for this dashboard to trigger this as a passed criteria. So 1.25 just means it's highly elevated. So the fact that we're at 1.47 means this is super elevated. And that was certainly one of the reasons that I took this trade. The other thing is this term structure slope, which is a mathematical formula that calculates the slope of the premium curve from the short month to the long month. So the more negative this value is, the sharper that curve is, which means the steeper the drop off of that volatility from the short month to the long month. So this thing, I mean, and again, the criteria for this is 0.004 is negative 0.004 is when this triggers. So a negative 0.02 was again a very extreme value and was a huge reason that I took this trade. So the point though is not specifically those values. It's just is the idea of the mechanics, that when you understand the mechanics, lean into the mechanics. And this is also why you can't just blindly take calendar spreads on any earnings trade and think that you're going to be in this kind of scenario. The reason this scenario exists is because the elevated volatility was extreme, and that term structure slope from short to long month was also extremely steep. And then that gives you this buffer fudge factor of you can be 10% in the money and still in profit 2 days after the event.
No, you're 100% spot on there, Viper. And really, what I like to say that my move is here on earnings is I am shorting volatility. That's basically what the nature of the play here is you're looking for that elevated volatility, selling it when it's high, betting it's going to contract, and buying it back when it's lower. And what I want to kind of call out is the difference in the metrics. And this is actually something I recently learned when I was trying to take my graphs that I use in Thinkorswim and apply them into TradingView. And I couldn't find anything that would give me the exact same graphs that I use in Thinkorswim. And I actually made a Pine script in Thinkorswim, and I was trying to translate it. It was a Thinkorswim script that I was trying to transition to a Pine script for use in TradingView. And I'm like, how is this possible that I can't actually get it here? And the reason is because my formula uses actual volatility readings, which are only available from a broker. TradingView doesn't actually have kind of the volatility numbers from options contracts and things like that. And so when I look up my implied volatility or that historical elevated volatility, what it's looking at is over time, what was the actual volatility of the pricing chains of the underlyings that I'm dealing with relative to where the volatility is right now on the pricing chains. And so all those data points are actual data pricing points that the broker keeps and then has them there for you to work with. And then the reason that doesn't translate into TradingView is because they don't have that data feed, which is why Viper is using this IVRV, and the IV is it's determining what is the volatility roughly would have been given the price fluctuations, because TradingView does keep track of all the price tickers, and so it creates kind of its relative volatility, or what it thinks the volatility would have been, because it is a mathematical formula. That's the different distinction there. The other piece with that term structure slope, which I think is almost like the forward-looking version of what I use, right? So I am looking at the current volatility relative to where it has been in the past year, and are we really high from that or really low from that? And what Viper's term structure slope is looking at is basically the current volatility relative to the volatility of that front month. And a really high ratio would mean very steep. Very steep meaning the current month is very, very high relative to the volatility in that farther out month, the back month. And so that's the logic there. And I want to emphasize that is so important. As Viper mentioned, you just can't go willy-nilly to any calendar, any underlying, and throw a calendar spread out there and get these results. I learned that when I was selling premium on earnings, because I thought, oh my gosh, this is like an ATM. I should just, if there's 30 earnings trades, I'm going to put on 30 earnings trades every week. And so every single earnings trade that went on, I put a play on, logged tons and tons of trades. Now I was doing defined limits, so everything was like Viper had $100. So I could put on 30 earnings trades in a week. And then my win ratio was not actually what I thought it would be. And the premium and stuff that I collected wasn't actually what I thought it should be. And when I started looking more and more and more, I found that the premium collected and retained and success factor was heavily dependent on that overinflated balloon, which makes sense when you think back at it, right? Because it goes back to that thing that I said. You're shorting volatility. You're looking for that extra high volatility and selling it, knowing and hoping that it's going to massively contract. So basically, I came to the same conclusion as you, Viper, through a different route, but the data that I came across supports the same conclusion you have.
Yeah. I mean, and it's really, do you want to be hunting with buckshot, or entering a shooting competition with a shotgun shooting buckshot, or with a sniper rifle? Like, and that's kind of what you were talking about, where, if you walk in and you just start spraying and praying, it's probably not going to end well. But understanding the mechanics, it's much more of this comes out with probabilities in your favor because you're lining up the shot. You're taking into account all of the factors that are playing into this.
Our grandpa used to always tell us, close only counts in horseshoes and hand grenades. And I think, in the more modern term, it's close only counts in horseshoes, hand grenades, and selling options.
That is certainly applicable in our Discord for sure. So the path, which we mentioned, I mean, this was basically same exact thing as what happened on AI. This thing popped huge, but on expiration. So this was I'm going to call this a little too close to the metal. And again, this is a lesson for another video, but the earnings, and then it was expiration the next day. But this thing came just smashing down on open, which I love to see. And you can see I'm about 4.5% still in the money. And yet I captured 50% profit on that. So that was once again, this was path. Again, I'm logging all of these things. If I bring that down real quick, so we can all take a look. Holy smokes. I forgot how big this thing was. This had an IVRV ratio of 1.8, and the term structure slope of 0.02. So again, if you just think of it in ratio terms, 1.8 means that the IV is significant, is almost 2 to 1 what the realized volatility over the past 30 days is. And it's sort of what Sprocket was talking about, that historical average, if you will. So it was elevated almost twofold what it normally is. So no question there why that came out at 50% profit. Again, had I hung on a little bit longer, this thing would have absolutely been just perfect. I mean, the perfect landing here, right to my strike, even dipped below it. And if, I mean, whatever. Ifs, cans, wishes, whatever. But it was 50%. I believe I closed this one. And when I closed this one, I wasn't as panicked. I mean, panic isn't quite right, but I wasn't as worried because AI, had this big pullback or big jump, and it was pulling back to this after hours high here. So that was one reason why the TA, the price action, had me say, let's just close this because we could find support here. In the case of Path, I wasn't as worried about that. I guess the scenario was a little bit there. So I could have waited, but I mean, I thought of this video where I was like, let's just do a video where I say I was 4% in the money and still got 50% profit out of it. So wrapping it all up then with why this asterisk about the day of expiration that we see here and why that's on my mind. And in short, it's because of my brokerage, which happens to be Robinhood at the current time, is where I'm executing these. I'm certainly not advocating, that Robinhood is great for everybody. It does what I need it to do for other things. And as I was learning the calendar spread, I did like how, and I'm sure other brokerages have similar products. I liked how Robinhood has a package builder, an options play builder, a strategy builder, where you can pick calendar spread. You can pick a long or a put calendar spread, and it'll build it with you. And so the only reason I like that is because that is a tool by the broker that is going to understand the limits, and not, there's this, if I tried to open these in pieces and piecemeal, I would have to do it for some underlyings. Like if it's $100 underlying, I'm going to have to do it in a specific pattern because the brokerage won't let me do part of this leg if I do it out of order, because of margin regulation, margin requirements and whatnot. So, but the reason this is a problem is if we take a look here, real quick at QUBT, quantum computing. This was a scenario exactly like what we were just looking at. So if I zoom in here, this yellow line, the $10 strike, was the call that I bought, the call calendar spread, $10. And after earnings, we went ripping, and it was just a 1 day to expiration. So earnings was where this move started, and the very next day was expiration day. And you can see that we are just deep in the money here. And we are actually 20, almost 30% in the money. So this was bad. This was the makings of a worst case scenario for this strategy, because it's expiration day. So we're 30% in the money. And luckily, this was happening on a $10, well, a $12 underlying. So I wasn't panicking because if somebody, not if, but that option was going to expire and it was going to get assigned. And I had the money in the account to cover that gap if I got assigned. So I was prepared for assignment. But what ended up happening was I found out, because as the day was unfolding, I started chatting with Sprocket of like, what should I do? And he suggested rolling the short month, which sounds like a great idea. I actually love that, to roll that for some reason. I think because it was built as a packaged play, Robinhood would not let me roll the front month. And so what I started accepting was, I was like, all right, you know what? I'm just going to take assignment here, and that's just going to be what it's going to be. But then the more I thought about it, I was like, well, to take assignment on a short contract on a short options play is to be short the shares. And Robinhood does not let you short shares. So I was once again confronted with what the heck is going to happen here. Because I can't be short these shares because the platform does not let me short. So I ended up finding out before the end of the day that what they do in this exact scenario, I mean, there's other trades that it could happen in. Around 3:30, Robinhood starts sweeping through all the positions. And if there's a situation like this, they will force you to buy back that options contract that is about to expire. And so as much as I was okay with the assignment, that was a pretty expensive contract. I mean, at this point, we are almost $3 in the money, and it's about to expire. And so it came out to being like $350, something like that, to buy back that option. So that's what happened. I got forced to buy that back at 3:30 before the market closed. And then it started to dawn on me of like, oh no, this whole strategy was built around the concept of defined risk. Every one of these trades I take, I pay $100 to do it. That $100 is what's at risk. And so some of this didn't click until it was too late. I could have kept that risk profile had I just closed out the entire trade before Robinhood forced me to leg out. So 2:00 in the afternoon, even though we're $2.50 into the money, I could have closed this whole thing and I would have been out $90 out of the $100 that it took to open it. In the future, that's what's going to happen. I'm just going to do that because that's the risk profile I signed up for. That's the risk profile my data collection is aiming for. So in the future, that's what we're going to do. So what ended up happening was I got forced to close that leg, which means now I still have the long month leg. And what I realized after close, because this was all happening in real time, was I was like, oh no, that means my loss can be significantly higher than I expected because of exactly what happened here on the chart. And so what I mean by that is half the leg, half the position, I paid, let's say $300, forcibly paid $300 to close that. So at that exact moment in time, my long option is worth, let's say, $350 because it has the same intrinsic plus a little extrinsic value into it. So now I'm holding, at the moment that I close that, I'm holding $350 of value in that long month. But if that price starts to move back towards the money, and if it starts to go out of the money, that $350 of value just keeps ticking down, so that this could have potentially been a $600 loss play by getting legged out like that. So it just so happens that I like the stock. So I honestly didn't mind having this long option for exactly what we're seeing here. So price did go down and I was like, this is definitely a worst case scenario. But then we came flying back up and the entire position was, even accounting for that $300 I got forced to buy, the entire position got into profit around $13 on the underlying. So we got entirely into profit. We did dip back down, but we're playing around here. So again, this is a July expiration, so I have time. We are creeping into profit territory again. So if we get a price push as the price action suggests, then this could turn into a real big winner. But this is exactly opposite the OKTA scenario. So OKTA has a much cleaner profit potential because the short month expired worthless. QBT is much different because the front month did not expire worthless. It expired very much value. So the end result is similar, but getting there was a lot more bumpy in this scenario. And it was certainly something for me to think about next time I'm deep in the money to just wrap the whole thing up and let's keep moving.
Yeah. So one interesting thing about what you came across, and it just kind of goes back to that big question mark about your broker. Um, when you're talking about, I'm just going to close the whole thing out, you can do that, of course. But in my mind, if we were going to go into expiration in the money, the other thing you could do instead of worrying about fills and spreads and all that is you could just tell your broker, exercise my long, please. And then at the market close is when your long will get exercised. And it would completely counterbalance the assignment if Robinhood didn't close out your short early. So I don't know if Robinhood would let you do that if it saw that you turned in your long for expiration. It's another question mark. But if you had a broker that did allow that, you could carry that short month all the way through to expiration by clicking the exercise my long, and then your original risk thing would be 100% intact.
Yeah. And honestly, thinking through, and again, it is a great question mark, but I'm suspicious. I'm thinking that they will certainly let you exercise that, but because that gets exercised after hours, I'm thinking they're still going to sweep through and force the buyback.
Yeah, exactly what I'm saying. I don't know that Robinhood would let you do that.
But well, I mean, I think they'll let me exercise, but they're still going to force.
No,
force
but it wouldn't guarantee. Yeah, it wouldn't guarantee your 100% risk profile, depending on where they made you.
Yeah, that's right. Because there's still
minutes.
30 minutes left. So yeah, for sure.
But this does bring an interesting point. And one thing that we're going to do the next trade that you have out there is I'm going to put the exact same trade on as you in my brokerage. And hopefully we'll get a move like this into the money. And I'm going to see if I can roll the front month leg independently, which I'm quite confident I can do, and to see if it will early assign, which I'm quite confident it will not do that sweeping thing. And maybe we'll get you to open up another brokerage account for some of this trades.
Maybe. I will, some things that I think will be interesting data points, because again, as I've, I don't want to say sold this strategy, but as I've championed this strategy, is again that small account size. So when you do the trade, I think it would be important to pay attention to how you enter it. And, is there even a glimpse? Is there even a window of time where you require more than $100 of margin to open it, even if it's a brief thing? I think that would be an important data point as well.
So I'm confident there won't be, just because of the way that the order is entered. Is when I enter the order, I don't do one and then the other. I put them both on the exact same order. So they are filled at the exact same time. It won't fill one and then the other.
Yeah, then in that case, I mean, because if we play through those mechanics of what we've talked about as far as options, I mean, when you mentioned on this exact trade, when you mentioned, oh, just roll the short month, I was like, holy smokes, that would be so cool to roll the short month, because that's just going to ring in a whole new set of premium, and I'm still kept in balance on that intrinsic value. I mean, I kind of love that outcome of being able to roll the short month, and then, let's re-roll. Let's see what happens.
And that brings us to the end of this week's episode. Just another deep dive there into the inner workings and learnings of a couple of internet schmucks trading some options. And hopefully you picked up a little bit of interest from there. I certainly am picking up some learning, because I never really pictured some of the brokerage limitations that Viper has come across. In fact, it's raised even questions. I'm like, well, I think this should happen. Oh, wait, they don't let you do that? I wonder what they would do in that case. So we'll kind of continue digging at that a little bit and see how it comes apart for different brokers. I have my own hypothesis on how that will pan out, so we will see. But it really just goes to show, and I want to highlight this again because I just don't think it's highlighted enough, as I mentioned in a previous episode, position sizing. The reason that Viper can do this is because he is controlling his position sizing relative to his portfolio. The reason he's not stressing about this stuff is because he has his position sizing set to a tolerable level relative to his portfolio value. And that discipline there, well, sure, it doesn't give you that cool social media post that you just made 6,000% return or whatever. It keeps you in the game, and it lets you kind of explore a lot of these mechanics and understand and experience them firsthand in real time. So please, please, please remember position sizing, and don't size your positions too large. That brings us to the end. So good luck out there on whatever it is that you're trading. Stay tuned as we kind of keep digging at this and learning little additional bits of information. Have fun, and remember, think outside the block.